All right, today we're diving into a really fascinating puzzle, something that looks like a total contradiction in the Australian mining world. We've got this company, Perenti. They just dropped some record-breaking results, and what happened? Their stock immediately tanked. It makes absolutely no sense on the surface, so let's dig in and figure out what the market could possibly be missing here.
So yeah, this is the big question, right? What in the world happens when a company seems to be firing on all cylinders, posting amazing numbers, but investors just run for the hills? It's a huge contradiction, and it really makes you wonder, what did the market see that the glowing financial report didn't?
And this slide, wow, this really lays it all out, doesn't it? I mean, look at this. On one side, you've got Perenti's results. Record earnings, profit is up a solid 12%, and they even bumped up the dividend by 8%. Now look at the other side. The market's reaction? A complete bloodbath. A 36% drop from its recent high. It's like these two pieces of information are from different planets.
Okay, so to even begin to understand this puzzle, you first have to get what Perenti actually does. Their business model is actually pretty slick, and, it's best summed up by that old saying about gold rushes. You don't want to be digging for gold, you want to be the one selling the shovels.
And this quote right here just nails it. The idea is totally different from buying a gold miner directly. See, Perenti doesn't need to bet on the price of gold. All they need is for the mines to keep digging, to keep working, to keep expanding. As long as that's happening, Perenti's getting paid. Simple as that.
So the whole company is basically built on these three main pillars. First, you've got their contract mining division. This is where the crown jewel, Barminco, lives, and they're one of the top 2 specialists in the entire world for that really tricky underground mining. Then, you've got drilling services, another top 3 global player. And finally, their tech and equipment services, which basically makes their clients, these huge mining companies, stick with them for the long haul.
Now, here's a key term you really need to get in this industry. Work in hand. Just think of it like the company's backlog. It's all the future revenue that's already locked in, signed, sealed, and delivered through long-term contracts. So this number gives us a really powerful glimpse into how stable their earnings are going to be.
And for Perenti, this number is just huge. We're talking 5.8 billion Australian dollars. That's enough secured work to cover almost 2 full years of revenue. I mean, think about that. That kind of visibility into the future is incredibly rare for any company in any industry.
Okay, so if the business is rock solid and they have this massive backlog of guaranteed work, what on earth caused that 36% crash? Let's peel back the layers on this sell-off and see what was really going on.
So it looks like the market got spooked by a couple of things. First, there was a guidance cut. But when you dig into it, the analysis shows this was all about the Australian dollar getting stronger. It was a currency thing, not a problem with their operations. Second, a big project in Botswana wrapped up. But here's the thing, management had already told everyone they'd fill that revenue hole with new contracts. So basically, the market freaked out over headlines without looking at the solid performance underneath. So when you put it all together, the conclusion from the analysis is pretty clear. The market's reaction, it seems completely disproportionate to what was actually happening. The punishment just did not fit the crime, especially, when you remember they had just posted record-breaking results.
And here's the really interesting part. While the market was busy panicking about those headwinds, it looks like it completely missed a massive, maybe even company-transforming, tailwind. Let's talk about what's been happening over in North America.
I mean, just look at this timeline. It's kind of staggering, right? Back in 2019, Perenti had basically zero presence in North America. Zip. Today, they're running 8 active projects. But the future, that's where it gets really exciting. There's a nearly $6 billion pipeline of potential work over there. We're talking about a whole new engine for growth.
And if we zoom out and look at the whole world, the picture gets even bigger. Right now, Perenti is looking at a global opportunity pipeline of $18.6 billion. That is the largest in the company's entire history. To put that in perspective, that's almost 10 times what the company is valued at today.
So what's fueling all this? Well, it's pretty simple. Record high gold prices. When gold is worth this much, the big mining companies have a massive incentive to pour money into expanding their mines. And they're especially interested in those complex underground operations, which, guess what, is exactly where Perenti is a world leader. It's a perfect storm for them.
So all of this brings us to the valuation, the big question. If the business is strong, if the growth story is so compelling, is the stock price reflecting any of that? Let's look at the hard numbers, because they seem to suggest a major disconnect. Okay, so this chart shows a key valuation metric, EV to EBITDA. It's basically a quick way to see how the market values a company compared to its earnings. And look at Perenti. It's trading at a multiple of just 3.3x. Now, what about its direct competitors? They're all trading somewhere between 4 and 6 times. That means Perenti looks significantly cheaper than its peers, even though it's a top-tier operator.
And if you look at it another way, through the price-to-earnings ratio, it's just 10.6. For a market leader that just grew its profits by 12% and has this incredible growth runway ahead, a number that low is, well, it's pretty remarkable. It's like the market is saying there's no future growth coming at all. And this one might be the most powerful number of all. Its free cash flow yield is over 10%. Now, what does that mean? It means that for every single dollar of the company's stock value, it's spitting out over 10 cents in pure cash every year. That is an incredibly healthy sign. It shows real, tangible value being generated.
Okay, so let's tie all of this together. On one hand, you've got the market's really negative perception, and on the other, you have all this really positive data on the business itself. So where does that leave us? What's the final takeaway here?
Well, it really boils down to two completely opposite ways of looking at it. The bull case is simple. You have a world-class company, a leader in its field that's on sale at a bargain basement price, and it's just waiting to be revalued by the market. The bear case says, hold on, this is a cyclical business, and right now it's fighting a strong Aussie dollar and just plain bad vibes from the market.
And that leaves us with the ultimate question. Is Perenti's low price a huge red flag? You know, a classic value trap just waiting to spring on unsuspecting investors? Or has the market totally overreacted to some short-term noise, creating its biggest blind spot? And maybe, just maybe, a really rare opportunity? That right there, that's the billion-dollar puzzle.